Hello everyone, my name is John Paul, DayTradeToWin.com. Today is October 15th, 2019. Hopefully everyone is doing well. We're looking at the TradeScalper software. These are the signals that the TradeScalper software initiated this morning, and there were a few of them. I want to see if there's a live signal so I can actually show you what happens when you trade during a live environment, unedited, how a trade progresses, the entry, what orders you should use, the exits, whether it's a winning trade or a losing trade. I'm going to see if I can give you an example of how that would actually play out during a live environment. Now, before we begin, I want to make sure everyone understands that trading is risky. Please don't trade with funds you cannot afford to lose. Please read all the disclosures, talk to your broker, make sure you understand what trading, Forex, stocks, futures is all about. Okay, just don't jump into it. Now I'm looking for an order to be a buyer or to be a seller, and I'm going to talk a little bit about the types of orders that you should be using. Now you have stop orders, you have limit orders, you have stop with limit orders, you have at market orders. Every order has a specific reason to be used. If you want to jump in to the market or jump out of the market, you should use a market order. Remember, there's slippage. Typically, the slippage is not in your favor. You usually get a tick or a pip of slippage if you just jump in or jump out. Sometimes, if the market's moving fast, it's actually in your favor. You actually have a better fill. But you have to think about what's realistic. And realistic is that you'd probably get the actual number or price that you want, or you would get a tick of slippage, so a tick worse or a pip worse. So you have to always consider that if you jump in at market. The other type of market, or I should say the other type of orders that exists are stop orders. And stop orders are basically acting like market orders. You're predicting in a specific price point either a buy stop or a sell stop. And it also, once it initiates, acts as a market order. So it'll hit that number, whether it's a buy or a sell, it'll react like a market order to fill you. So you have to consider there may be slippage with that. Now, a limit order is a little different. A limit order says I want to buy on a limit or sell on a limit, and you're actually telling your broker that I don't want anything except for this number. So as simple as I can make it, especially for the new traders, when you use a limit order, you're saying I want this price to be filled at or nothing. If you can't fill me at that price, then don't fill me. Now that has its pros and its cons, because sometimes you've noticed as a trader that it touches your price and touches your price and touches your price and you're not filled. And that obviously is frustrating. And there's an order queue. It's called an order queue where you're in line to be filled. And what happens is once your number comes up, like a ticket system, you're filled. So if there's, let's say, 1,000 contracts trying to be filled and you're number 900, you have to wait until all those other orders get filled in front of you before you get filled. And that's how a limit order is able to give you an exact entry or exit at that specific price. So you're saying, I want this price and I'm willing to wait for it until my number, my ticket occurs. So if it goes through that price, so let's say it hits that value and continues to go through it, everybody's filled, you're filled, and you get no slippage. Now the other order I want to talk about today, besides a limit order and a market order and a stop order, is going to be an order that is called an MIT, market if touched. And a market if touched order is something that I like to use because it ensures that if that value is touched, I'm filled. Now, whether I have slippage in my favor or slippage against me, or I get the exact price, you're really saying to the system and to the broker, to the platform, you're saying, I want this exact price. And if it touches that exact price, get me in or get me out. So you don't have to necessarily click the market order. If it touches, it'll do it for you. You don't have to place a stop order. You have to place a market if touched to exit the market. Typically, you use that to exit the market to ensure that if it touches that target, you get out. So I'm going to use that market if touched order to help me get out of a trade if one comes about here. Now, as I wait for an order to be shown through the software, the TradeScalper, I have to pay attention. I have to enter into the market in a reasonable amount of time. If I'm scalping, I can't wait 5 minutes to enter after the order appears. You may want to use a market order. You may want to use a stop order or a limit order. But the idea is as soon as you see the order, you want to be long or short. So you have here a short entry at 29.98 quarter. That means you want to go short at that price or within a tick of it, especially if you go in at market, you can probably get within a tick of it. And so I'm going to use a sell stop here to go short
Order filled.
The market. And you can see the price 29.97.75. So this is a horrible fill. And this is an example to show you if you're not paying attention or if the market's moving very fast, you're not going to be able to get the order that you want, right? Or the price that you want. So you got to be careful. You can't let this run away from you. As a scalper, you want to be in, you want to be out, and you want to be done, and you want to move on to the next trade. So this is the fill that I have, 29.97.75 short. Okay, very simple. I entered, I'm in, I'm out. Now we manage the trade. Typically, when you talk about scalping the market, you're not going for large losses. You're going for small losses. Now, what's a small loss? 6 ticks, 5 ticks, 4 ticks. Maybe if the market is very volatile, you can go for a little bit larger target and afford a larger stop, right? So it has to, the comparison for your targets to your stops have to be somehow in sync. You can't risk a lot to make very little. So I have here a target of, let's say, 3 ticks. I have a stop here that's going to be less than 6 ticks. And so I'm protecting myself in case the market runs away from me. If my stop is so tight, which I think a lot of traders fail to understand, if you have your stop so close to where you entered and so tight, just the market gyration up and down will knock you out of the trade even before it gets going, or you even have an opportunity to see it maybe retrace a little bit and then continue in your favor. So you don't have to have your stop so tight and so close that you're going to immediately get stopped out just because the market moves up and down. Now, one of the things, if you haven't seen the videos on how I use the ATR, the average true range, to kind of identify the current market conditions, if the market is slow, if the market is fast. Okay, so now we have another short signal. It's a double wick short. You can see it there, 29.9850. Another great opportunity to be a seller. So if you want to sell the market, again, or if you want to hold on to your position because there's more evidence that the market is going down, you still have this short bias based on the TradeScalper software. So I want to stay short, or I want to add a position to go short. Once again, maybe averaging my fill, I get a better fill. And I'm going to wait until the target is met. Now, 29.97.75 entry with a target of, let's say, 29.96.50, just kind of giving you an example of a 3-tick target, may happen very fast. And when it does, you have to make the decision, should I get out? Should I hold it for a trailing stop? Or should I add more of a sell position so I can see the market continue lower? And adding more positions to it. Now, I don't agree with adding positions. I like to be in, I like to be out, so I'm going to take that off the table. But I do want to make sure that once the market hits my 3-tick target, that I begin to make a decision. Should I get out of it? Should I lock in profit? Should I break even? So I'm going to use a market if touched order to get me out of this position at 3 ticks, 29.97. So this is how we do it. Buy market if touched, 29.97, or buy in a limit. If you want that price or only that price, I'm going to go with a market if touched because that's what I recommended in the beginning of the video. And so if
Order submitted.
29.97 is touched or tagged, they call it tagged. If it's tagged, I'm immediately, or the platform will immediately execute the trade and say, get out of the trade, get out of the market, buy it, take profit. So remember, I'm doing this very slow. I'm showing you these examples, but during a real live, fast-paced environment, you have to be faster than what I'm doing here. This is just an explanation of how this is working, so you have a clear understanding of what to expect. 29.97, market if touched, get out of the trade. The entry sell 29.97.75. I'm looking for about 3 ticks. I also have to consider once it touches that target, expect the price that you want, maybe a tick better, or maybe a slippage of a tick
Order
worse.
filled.
And it's exactly what happened. 29.97 quarter is the price that I got filled, 1 tick of slippage. So these are the examples of different orders, how to trade the TradeScalper using a limit, a stop, an MIT, market if touched. And now we do this all over again. If there's another opportunity to buy or to sell, it's the same thing. If you have any questions, if you'd like to join the next mentorship class beginning October 22nd, there's still seats available. Email me at support@daytradetowin.com, and I hope to see you in the next class.